Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Michael Normyle, U.S. economist at Nasdaq, to discuss first quarter S&P 500 earnings and how it compares to historical means. It's great to see you, Michael. Welcome back to Trade Talks. And let's kick it off and talk about the overall performance and then break it down into industry performance.
Sure. So we're right at the tail end of earnings season at this point. We've got 96% of S&P 500 companies having reported. And so we're on track for about a 2% contraction year over year in Q1 earnings. And that's after seeing a 4.5% contraction in Q4. But it wasn't universally weak. If you look at companies where they get 50% or more of their revenues from the US, they gained 3% year over year in earnings. Whereas companies that were more internationally focused with more than 50% of revenues coming from international countries, they saw a 10% decline in earnings. So that's kind of suggesting that the US economy was a bit stronger than the global economy. And if you look at sectors, consumer discretionary was really the standout, seeing 55% growth in year over year earnings, with people spending on cars and hotels and restaurants. And even financials rose 5%, which might seem surprising. But you have to remember that the banking crisis didn't start until mid-March, so that's really the tail end of Q1. And so higher rates and low defaults were helpful there. But other sectors like tech, healthcare, communication services, and materials, they all fell. So that's why we saw a negative number overall.
And Michael, what was the earnings beat percentage?
So it was 78%, which is higher than average, which is usually around 73%. And that's one of the reasons why earnings actually isn't as bad as we thought. Early on in earnings season, we were kind of on track for about a 6% decline. But with more companies beating and then beating by more, where they saw a beat of about 5% on average, that's better than the typical average, which is about 3.5%. So that's contributing to why it wasn't quite as bad as it looked. But as far as share prices go, beats didn't necessarily translate to gains, where companies that beat only saw about a 0.3% increase, and that's compared to a typical increase of about 1% over the past few years. But companies that missed fell about 4%, and that's against an average of about 2% over the last few years.
And if we take a deeper dive into historical performance, what does it suggest to you there?
Well, so right now we have negative quarters back to back, but no recession. And if you look at how earnings perform during past recessions, it can get pretty ugly pretty quickly, where you see, for the last 5 recessions, we've had around negative 10% or worse earnings growth. And so that's something that, would hurt valuations and could lead to a sell-off. Right now, though, we only have a small decline, and you've seen cases like in the mid 80s and 2015-16, where we had only a small drop in earnings without recession. And so that's still possible, and analysts are looking for positive earnings by Q3 of this year. But so what you see is the economy slows, margins fall, that's bad for earnings, and that could be contributing to sluggish markets. But despite that, the Nasdaq is up 20% this year, so investors do look at, future revenues.
All right, Michael, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.